and welcome to our interview series where we bring you valuable insights from top fund managers across leading AMCs. Joining me and my colleague Chirag today is Venugopal Manghat. He's CIO-Equity at HSBC Mutual Fund. Welcome, Mr. Manghat.
Thank you very much. Thank you for having me on the show.
Great to have you back with us. Now, to begin with the Sensex down 13% and mid caps and small caps facing steeper declines, do you think the worst is behind us, or should investors brace for more volatility in the near term?
Yeah, that has two questions to it. First of all, I think the markets have corrected fairly significantly in this last few months. We've seen a continuous correction of about 5 months, and the mid and small cap indices have corrected almost 27 or 28% by now. Individual stocks have corrected even more. Some have, gone down almost 30 to 50%. So I guess the valuation excesses in the system have been removed by now, and I think some of the earnings cuts have also got factored in. So from a fundamental perspective, yes, I think the markets are getting close to a bottom or has bottomed out, is our view. Whether that means that the volatility will be less in future, I can't say that for sure, because globally things are still uncertain, and if the US markets, for example, correct even more from current levels, then along with that, the economic scenario in the US gets weaker, then obviously world markets will have some impact, and India will probably be a part of that. So I guess volatility could continue for some more time, but for the time being, we've seen the worst in the price, and therefore the markets have, in our view, bottomed out.
What domestic and the global factors do you see as a key driver for the recovery in the Indian equities over the next 6 to 12 months, considering we have seen sharp FI flows and domestic growth, geopolitical risks across the thing?
Yeah, so I think the correction has been driven largely by fundamental factors, domestic factors largely, with the economy slowing down in the current financial year. The first half was fairly weak. We had a reasonably better third quarter. We need to see how that progresses going forward. The fourth quarter numbers, therefore, will be keenly watched. And then the expectations for financial year 26, I think the central bank has already put out its numbers of 6.7% or so in GDP growth. That's a very important data point that one would have to keep a watch out for. Hopefully, we've seen the worst again the first half, and then on track for a recovery going forward. Many of the factors that contributed to that slowing growth has reversed in our view. So the elections and all of those factors have already played out. We've seen the liquidity situation, which had tightened last calendar year, getting slightly better now. Hopefully, we'll get that part to improve even further going forward. Some part of that earnings decline on the back of the slowing economic growth has also been factored in. Hopefully, by the end of fourth quarter, the earnings cuts also will have played a role and have should get reversed as we go into next financial year. So I think from a domestic point of view, I would look for the economic growth. I would look for government spending, which had slowed down last year. That needs to improve. We've seen some evidence of that in the recent months, but that needs to improve further and continue and improve further, maybe into the next financial year. Earnings growth has to improve. This year, we've seen a subdued growth. I think at this current juncture, the street is expecting fairly high growth estimates for next financial year. Given the global uncertainties and the slowdown, maybe that will have to be toned down a bit, but we'll have to see how it progresses. And in this regard, the consumption sector also will be keenly watched, given that we've not seen a very significant improvement on the consumption side. Recovery has been elusive. with all the changes that have been announced in the budget, the tax changes and the first round of rate cuts, hopefully some more to come. That should translate eventually into consumption, an improvement in consumption numbers. And so that's again a data point that I would be watching out for to ascertain the pace of recovery for the markets. Along with this, obviously, the global factors will also play out. But I think if we have a strong domestic economy and earnings growth, I think we should, given the correction that we have seen in the markets, I think we should remain fairly strong going forward.
Right now, after the recent correction, do you think Indian equities are now attractively priced, or are they still trading at a premium?
Well, I think the markets have corrected a fair bit, but given the rally that we saw in the previous 2 years, and the high valuations that it had taken the individual sectors or stocks to, I think from a historic perspective, valuations continue to be slightly on the higher sides in some pockets at least. In some cases, they have corrected as well. So in cases like, for example, in capital goods, some stocks have corrected to below historic levels. Financials continue to be still, low in terms of valuations on a relative basis as well within this market. And similarly, on a bottom-up basis, now you're seeing stocks which are, priced lower than what they were in the past cycles or in the long-term average. So in pockets, yes, valuations have become more attractive. Some have become fair or closer to the long-term average. However, some continue to be expensive. We may see some more corrections there, or if the market turns, then maybe those valuations will continue with the growth expectations from these companies. So partly, I think the valuation excesses have got corrected, and markets are looking better now.
Sir, can you explain your core investment philosophy and how it adapts to the different market cycles, especially during the uncertain times like we are seeing right currently?
Yeah, so the investment approach and strategy remains the same. So we, in general, as a fund house, we look for good quality businesses and companies in running such businesses, and run by people with high integrity and with vision and drive to really take the company and the business forward. So good quality companies at reasonable valuations are what we are looking for, and that doesn't change. Obviously, if you buy lower, the returns can be higher, and you can get higher alpha. But the overall strategy remains the same. So what we have done in these times where there've been some cuts to the forecasts on the economy side as well as on earnings growth, we've looked at stocks that are expensive, having cut the numbers and then stress tested them to see if the valuations still remain expensive. In such cases, we've cut down our exposures. Some sectors where we were very significantly overweight, we've cut down exposures. And overall, I think within in all the funds that we run, wherever it was required, and of the high beta sectors, we've cut down that a little bit, given that the current year is a little uncertain with the global setup, and we need to still see the economic recovery going through. So keeping those things in mind, we've moderated some of those exposures. But apart from that, the basic thought process remains the same. We have always been bottom-up investors. We have been active investors. We look for ideas all the time, and we are long-term investors. We remain patiently invested, and those facets remain the same despite the market turbulence.
Right now, coming to a few fund-specific questions. HSBC Value and Small Cap Funds, they have consistently ranked among the top performers over the 3, 5, and 10-year period. What key investment decisions or market factors have driven this success? If you could elaborate on that.
Yeah, so I think we have remained true to label. We have been, as I mentioned, completely bottom up in our approach to investing. And at all points in time, that's been our focus: identify good companies and stay invested for long periods of time. The portfolio, turnover ratios for these funds have been on the lower side, so clearly reflects that we've been invested in companies for long. And I think the quality of stock picking, the research that we do has been the key reasons for the outperformance, I would think. I think we've done the basics right at all points in time. We remained true to label and continued with our thought process despite turbulence off and on in the markets, and that's rewarded us over the longer term. So those are the key reasons. I would think that the fundamental research effort that we put in clearly has helped us in this journey over the last so many years.
So, about choosing the small cap stocks compared to the mid cap or the large cap is quite difficult, or in the market. So, how have you selected the stocks which has led to this fund continually being the top quartile? Could you just put a light on the investment strategy of the small cap fund particularly?
Yeah, so we've always, we've looked for good stock picks in multiple sectors. We've been bottom up. The small cap fund has been almost, close to 100% bottom up in the approach to investing. We've looked for companies which can challenge the larger ones, the smaller companies that can bring disruption and challenge the larger ones in the sectors. We've looked for companies in sectors that are evolving and becoming larger over time. We've looked for companies in niche segments which add significant value. So multiple such segments we've looked for. We've also looked for trends that have played out in the markets. For example, the investments theme that played out. Now we're looking for a consumer discretionary theme for the next several years, because I think that's the space where you can create or generate alpha over a long period of time with the demographics and with the per capita GDP increasing. There is a whole host of sectors within that consumer discretionary space, significantly underpenetrated, and shift happening from the unorganized segment. So we look for ideas there now. So it is a result of multiple things, selecting stocks in each of these buckets, and then investing in the right themes as well at the right time. So all of those have contributed. Basic factor is obviously stock picking, which has been a result of our research effort.
Sir, many of the HSBC AMC's equity funds have thrived in 2024. What were the key contributors and how much role did the momentum play in the stock picks?
I don't think we've played momentum at all. I think we've been convinced on the investments theme, which powered the markets for most of the bull run that we saw over the last 2 years, 3 years. And we have invested in the right companies to really outperform the market, and that's what has led to the strong performance for that period that you mentioned. We've continued to remain invested in many of these names for long periods of time, the individual stocks, I mean. And therefore, for example, in the small cap fund, the portfolio turnover is quite low compared to even the category average, or if you look at the rest of the funds in the category. So we have remained invested in the picks that have been generated through our research effort, and we've not chased momentum or done any short-term moves to generate alpha. We've always remained long-term and identified the best companies that can generate alpha over time.
Right. But most HSBC equity funds, they've started 2025 in the bottom quartile. So if you could share with us what led to this dip, and are you making any changes to turn things around?
Yeah, as I earlier mentioned, we have been making some changes, some moderation to where we were significantly overweight and where we are underweight. But before that, let me also say that the markets have corrected very significantly. It's taken a U-turn, a complete reversal of sorts from the last 2 to 3 years trend that we've seen. It's reversed in less than 40 or 50 days, with absolute ferocity. So stocks are down most stocks are down between 30 to 50%. The bigger hit has come, especially in the months of February and to some extent in March as well. So I think that has played a role in the underperformance. I think we've always been more exposed to the broad markets. As I mentioned earlier, we've always believed that stock picking can and will deliver higher alpha, and we've stuck to that. We have been bottom up in our approach to investing, and so we have a higher exposure to the broad markets. So that higher exposure to the mid and small cap range, and the higher exposure to some of the themes that were playing out well during this and have driven earnings growth over the last 2 to 3 years. Those have reversed actually in the last 20 or 30, 50 days or 40 days time, and that has led to the performance going down a bit. But we continue to believe that if India has to grow at 6.5-7% also, which is lower than what it was doing in the past, the last 2-3 years. Even to achieve that pace, there have to be some leaders, some contributors to the growth. Investments is one theme that played out very well over the last 2 years, 2 to 3 years post-COVID. We believe that that segment should continue, plus the consumer discretionary space will continue. So we were overexposed to some sectors. We're cutting down that. We're moderating those exposures. We were under invested in some, which paid off for a large part of the 2 years time that I mentioned. But now we are kind of balancing that the portfolio with some of those sectors where we are underinvested, and cutting down the exposure to sectors that we were overexposed at this point. But we continue to be positive on many of these drivers: investments, consumption, financialization. I think those themes will continue to drive India's growth, and therefore earnings growth for the markets as well, and they should be rewarded over the next several years.
Sir, recently we have seen many of the equity funds raising cash to deploy the markets in anticipation of a correction. What's your stance on taking cash calls, and how do you determine the optimal level of cash in your portfolios given the current market scenario?
So as a fund house, we don't take cash calls. We don't use cash as a strategy to outperform. My belief and learning over the years has been that unless you are in significantly higher percentage of cash, which is very unlikely that you will get into that kind of phase. That's not going to help you outperform. In a market like this where you've seen 20-25% correction, maybe to some extent that can add value, but we are not looking to add value in the very short term. We are long-term investors. We remain fairly well invested all throughout in this period, given the so we've always been in the 1 to 3 or 1 to 4% cash bracket, which is required to be kept for redemptions or for opportunities. But beyond that, we've not really played cash as a strategy. The current juncture, we have slightly higher percentage of cash, given that we need to restructure portfolios a little bit with the changing conditions, with the global outlook, with the new themes that are evolving. So to that extent, we've kept a little more cash in many of our funds. So I would say ranging between, let's say, 3 to 6% or thereabout. So it's still not a cash strategy. It is to restructure the portfolio. It is to find the right opportunities and move it to the right sectors as and when it's suitable.
Right now, Mr. Manghat, in our last interaction in, I think, December 2023, you mentioned that HSBC Midcap is not a flavor of the season portfolio. It's high quality, reasonably good valuation as an entry point, businesses with a long runway for growth. So at the same time, we did notice that the fund incorporates momentum plays. So how do you balance long-term conviction with short-term opportunities, if you could share with us?
I don't think we've played momentum in any of our funds. It's just that, we saw an opportunity in the investments team. We saw the capital goods sector or the investments related sectors, cyclical sectors really doing well for the economy, and therefore the earnings growth getting much stronger, the visibility of growth being there. So we've kind of increased the exposure in some of some sectors like that, which is backed by fundamentals and earnings growth. It's not been a momentum-based approach or price-based buying or selling that we've done. So I can't see a very big difference from between our thought process or approach to investing and what we've done in the fund. It remains true to label. We are into good quality companies. These companies have been identified by our research team, and we have some of these names across most of other portfolios as well. So it's not that we've chased some stocks which have led to the outperformance. It's been our fundamental research effort which has thrown up these ideas, and maybe we've maximized the gains in the space or in some of these stocks within the portfolio, which has led to the extra alpha that was generated in 2024.
Right now, before we wrap up, one last question. So, following the recent market downturn, which sectors or investment themes do you find attractive for the medium to long term, and which of them still seem overvalued despite the correction?
So on a shorter term basis, I would think that from a valuation perspective and from a sector which has not performed as well or not contributed as much, I would think that the financial space looks relatively better. Some of that has already played out, but where valuations are still reasonable, I would say. On a medium-term basis, I would still be quite positive on the investments theme. I think there are enough opportunities for India to grow, and for India's growth, you need high-quality infrastructure. There is still a lot to be done to reach, a higher level or a higher quality infrastructure in the global context. And without that, I think our competitiveness will continue to be low versus China or other competing economies. So I think that's on a medium term a good opportunity. It will continue to throw up good opportunities. On a longer term basis, I am extremely positive on discretionary consumption. I mentioned the demographics at play. 140 crore population with a 28-year average age, with a close to $2,700 or $2,800 per capita GDP, likely to go to $5,000 plus over the next 7 years. I think that's the a dream setup for investors to really take advantage of. So my sense is the consumer discretionary space will give you the best alpha and the best long-term bets from this market. And we are looking for ideas. We have some investments there, and I mean this is across multiple sectors within consumption, and many of these are extremely underpenetrated, and there is a large unorganized segment which is getting converted to the organized space. So huge opportunity. I would expect some of these companies to become much larger in size and scale by 2030, and I would go to the extent of saying that maybe the indices will have more stocks from the discretionary consumption space in the next 5 to 7 years. So we are extremely positive on that space on a longer term basis.
All right, then with that, it's time for us to wrap up this chat. Thank you, Mr. Manghat, for taking the time for this interaction.
Thank you. Thank you very much.